Good morning, magandang umaga po. We are going to talk today about capital gains. Someone asked me the question, gee, how do I pay tax or declare income earned from trading in stocks and such? It took me a while to do this because I figured probably not too many people will be trading stocks. On the other hand, if you're retired, trading stocks is nothing. You can do everything via internet. And I'm not going to talk about how to trade stocks, but how to compute the gain and how you declare the gain on your income tax return. Not in the Philippines, but in the United States. That's what we'll talk about. As I mentioned, we're not going to talk about how capital gains is taxed in the Philippines. The reason is, I don't know. At the moment, I don't know. And I don't know that I will ever know because I have no plans of trading stocks in the Philippines. For one thing, I will not be full-time in the Philippines. I will only be trading part-time. And I'm very familiar with trading in the United States. And in some ways, the US market is more stable than the Philippines. But then for the benefit of the people who are actively trading stocks, I'm going to explain how you compute the gain and how the gain is being taxed. So again, I will present it on PowerPoint so it could be easily understood. Here goes. The best way to explain or to illustrate how capital gains is computed is through an example. You will have to compare the amount of money you received against the amount of money you paid. So the first thing you do is compute the net proceeds on the sale of your stocks. Let's say that you sold your stock at $75,000. You deduct from that sales price any commission and fees that you paid and any other selling related expenses. Now, I can't think of any other related selling expenses, but I threw it in there just in case there's any. And also, this will apply to not only sale of stock, but also capital assets and stuff like that. This is just to compute. This is not the tax yet. This is just to compute how much your gain is, okay? So here, you receive a net selling price. This is the amount you realize, $74,890. Then you compare that against what you sold. Let's say what the cost of what you sold. Let's say that you purchased this for $40,000, that you sold for $75,000, but you bought it for $40,000. But then you have to add the commissions that you paid when you bought this, let's say $50,000. Other acquisition-related expenses, $10,000. Your total acquisition cost or purchase price is $40,060. You deduct that from the $74,890 you receive, and this is the amount of net gain that you realized. So that is how you compute the gain on the sale of assets. We make a distinction between long-term capital gain and short-term capital gain. Long-term capital gain is any stock held for more than a year. Okay, so if you held the stock more than a year from the time you bought it to the time you sold it, this is what will apply. If you're single and your income is below $40,001, you pay no tax. If you're married filing jointly, your income has to be below $80,001 for you to pay no tax. Now, if your income is $40,000 to $441,450 and you're single, it's 15%. If you're married, it's $80,000 to $496,600. You can see in the first bracket, it's double. Here comes the so-called marriage penalty again on the capital gains. It only went up a little bit from $441,000 to $496,000 when you're married. At any rate, we probably are not going to reach that income level. And if you reach that income level, you probably will have an accountant to do the magic on this anyway. But this next layer, I have not even seen in some publications. They stop up to 15%. But the reality is there is a 20% layer if your income is over 441,450, single, and if you're married, if it's over, your income is over 496,600. Now, this is long term. A lot of people will probably have short term. Some are probably going to be doing day trading and such. The 220, and again, this is for 2020 tax rates. Be sure to check the internet for the current rate because they do change this. They do change these limits here. This stays a little more or less constant, but these numbers here do change. So check it out. For 2020, short-term capital gains, meaning stock held for less than a year, it will get taxed at your ordinary income tax rate, meaning your tax bracket. As you know, as you probably know, as your income grows, the tax rate go up, okay, in the United States. So whatever that rate is, if it is short-term, the whole thing gets taxed at ordinary rate. So if you're day trading, it's just like your salary and business income, it will get taxed at ordinary rate. Now, if you're an investor, long-term investor, you get a break. So if you invested something, let's say a certain amount, and left it there for 5, 10 years, you get a break. It can grow to some humongous amount and they will only tax you at 15%. Okay? Now, how do you report this? In most cases, you'll use the purchase and sale information to complete Form 8949 so you can report your gains and losses on Schedule D. There you have it. It's relatively simple. The first thing to do is determine what the gain is by adding, subtracting adjustments to your selling price and purchase price. Then once you have that gain, next thing to do is how to compute the tax. Now there was a big change. It used to be the last time I was trading in stocks and I was paying tax on it. It's different. It's only a difference of long term or short term. And it used to be that if it's short term, everything gets taxed, just like today. But anything long term is 50% tax free. But it still gets subjected to the same ordinary tax rate. This time it's different. Short term, no difference. But long term, instead of getting taxed 50%, there's a certain exemption. First 40,000 for single, free, you don't pay any tax. First 80,000 for married filing jointly, free for free of tax. That's a big change. Now, I don't know when that changed, to be honest, since I wasn't constantly following up on it. But that's how it is. Now, this is trading in stocks. The computation of your gain will probably apply to other things like sale of your home and things like that. Same deduction. That's the reason why I put other deductions in that illustration. To my knowledge, the only expense you incur when you're trading in stock is commission, and it's in many cases now even commission is being eliminated. There's no commission. It used to be $7 per trade. It used to be a percentage, and then there's an odd lot, there's an even lot. It's so complicated. Now I just noticed it's free. And the reason is, although I'm not trading now on my regular savings account, I am trading on my IRA. Because I'm trading within the IRA, I don't declare any tax because it's tax-free. You get tax at ordinary rate when you withdraw, when you make a withdrawal from your self-directed IRA account. Okay? So there you go. Next time we'll talk about, on another video, will be the gain on the sale of your home. Now, a lot of retiring people may want to sell their house here in the United States. How does it get taxed? In the Philippines, it's very simple. You pay 6% of the selling price. No cost, no deduction, no computation. Whatever you sell it for, you get taxed at 6%. Very simple in the Philippines. In the US, it's a little bit more complicated. We'll talk about it next time. So I hope you enjoyed this video. Please do share it with others who may be interested in trading stocks. And please do like and do subscribe to my channel. I would really appreciate that a lot. Thank you, and make it a great day.